Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Welcome to Master the Markets. I'm Barry Habib from MBS Highway, and this is created exclusively for Mortgage News Network. Another crazy week last week centered around the situation in Greece, some inflation data, and the Fed's rate decision and policy statement. Now, this week, we're going to get some housing data, which has been coming in very strong. I expect that to continue. And there's also some interesting historical information that comes into play. You see, last Friday is what you'd call, it's a crazy name, a Quadruple Witching Friday. What does that mean? It means that in the stock market, 4 different areas of the market had options that were expiring, and they call that a quadruple witching. Now, if history is a guide, when we take a look at this, if you go back historically speaking, on the June quadruple witching, the following week is typically a bad one for the stock market and a good one for the bond market and interest rates, which, look, history doesn't always repeat itself, but it is one positive factor. And in fact, on Friday, the stock market started to weaken the second half of the trading session, and mortgage bonds and the overall bond market picked up some momentum, giving us some pretty good pricing in the bond market on Friday. Now let's go back. Let's talk a little bit about some of the events of last week. First of all, when we talk about the news, the big news of the week was the inflation data, or lack thereof. It was a very calm number inflation-wise. However, this was the last number that I anticipated being a soft one on the inflation front. Remember, we talked about this in the past. Now, the following months that we're going to see, we get the new inflation data, and it replaces the inflation data from 2014. So the next report we're going to get in July will be June's inflation report. So June of 2015 will replace June of 2014. And those 2014 numbers were so low, we could start to see, and should start to see, an uptick in the overall rate of inflation. That will put some pressure on the Fed. And speaking of the Fed, Janet Yellen was kind of too chicken to really do anything, as were the other Fed members. Remember, we talked about this in the past. The beginning of the year, everybody was talking about a Fed rate hike in June. We said, no way, no way, no way. Because when you take a deeper look, the voting members of the Fed, 7 of them are doves, only 2 of them are hawks, 1 is a centrist. Doves being very accommodative, very reticent to pull the trigger on a hike, only 2 of them really with the gumption to do so. Now, if inflation starts ticking up, they'll have to. And what's interesting about this is that the bond market really wants the Fed to hike rates. As we've discussed in the last couple of weeks, inflation, if it continues to tick higher, eats away the fixed rate return that you get over the long term on a bond. If you issued a mortgage yourself and you get a monthly payment, inflation makes the value of the buying power of that monthly payment worth less over time. So a lot of pressure now, 2 Fed meetings from now, September 17th, circle that date. If the Fed's going to be under pressure to hike rates on September 17th. If they don't, the bond market will probably do worse and demand higher interest rates. If the Fed does cut rates and kind of signals that, hey, we're going to cut rates, hike rates, pardon me. The Fed hike rates on September 17th and says, hey, we're going to hike rates and we're going to kind of just stand pat for a while. That's kind of a winning situation for the bond market. It means that the Fed's doing something about inflation, but they're not going to get the shorter end out of control. So bonds should rally. Now, that said, when we take a look at the other factors that are out there, Greece is an important situation. Greece has a small economy. Greece has a small amount, relatively speaking, of debt. So why is it so important? You see, with Greece as part of the European Union, there is some stability there. And if Greek banks do go under, or if Greece defaults on its debt, which we're going to find out on the 30th of June, right around the corner, if they do this, well, we're going to see potentially an exit of Greece from the European Union. And while some people might say, hey, that's a long time coming, that might be a good thing, it will be the first time that this has happened since the European Union has been formed. And in the past, when they've been able to keep it together and work things out, this would, so to speak, admit some sort of failure and now set a precedent. The worry there is that other nations that have some debt issues, like Spain, like Portugal, like Italy, may take that same path. Why would they do that? Because it allows them to devalue their currency. It's a great way to get out of debt. Countries have done this in the past. They chalk up all kinds of debt and they say, hey, what we used to call, just like Mexico did not too long ago, they said 1,000 pesos, well, it's going to be equivalent to one nuevo peso. So whereas they owed, let's just say, $100 million, well, that becomes equal to $100,000. Pretty crazy stuff. And the debt holders get wiped out, savers get wiped out, but it's a way to eliminate the debt that you owe. So the fear is that if other nations do this, people holding that debt might say, hey, I don't really want to hold the debt of these countries as earnestly as I have in the past, and therefore maybe just lighten up a little bit on those holdings. It wouldn't be imminent that other nations would leave, but it would start to create some questions and some concerns. So what happens is the yields on those securities start going higher, and where that money finds a safe home are places like the United States and Germany, where it's believed to be a lot more of a safe haven. So if Greece exits, we will see interest rates improve here as money flows into U.S. treasuries as a flight to quality. But if they work out the situation at the end of this month in Greece, then I expect this trend that we're seeing in interest rates here, where we're seeing a slow move higher in rates, worse in price, lower in bond prices, to continue until perhaps the Fed does something to curb inflation. If you want to follow this every day, just go ahead and take a free subscription to MBS Highway. We talk about this stuff every single day, give you the charts, give you the alerts. And man, if you're in the mortgage business and you've been a subscriber, you know the benefits because we have protected you all the way through. So go ahead, subscribe. It's free for 2 weeks. Why not do it? Hope you have a great day. See you next week. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage. Master of the Markets airs every Monday at 7 a.m. Eastern Time and can be viewed on MortgageNewsNetwork.com.
This is Mortgage News Network.